Welcome to Kneppy Invest the World. Now, August is, some people, Christmas is their favourite time of year. Maybe Easter, maybe autumn. But for me, I have a few favourite times of year. August is my favourite. February is second favourite. Then I have some subsidiary favourite times of year, and those are, funnily enough, at the end of January, end of April, end of July, and end of October. And they're all in line with the times where companies are reporting. They're giving information on how they're doing to us investors. And during August, many ASX companies are giving us their 4-year reports on how they're doing. And the company I'm talking about today, my Kneppy stock of the day, a company called Base Resources, gave us a report on August the 24th, which was a Monday. This was yesterday. And I'll just discuss about this company and their report. So essentially they are a mining company, and they're into mining mineral sands. So mineral sands, in fact, is rutile, ilmenite and zircon. I think that goes into producing titanium oxide, and titanium oxide then produces stuff like pigments. So it's dye for paint and stuff like that, and also titanium metal, which, if I remember correctly, is non-corrosive, and has the highest strength to weight ratio of any metal, and therefore because of that is used in aerospace, defense, jewelry, that sort of thing. So they are a miner of that. I mentioned Aluka in my first video about side dev, and Aluka is another mineral sands miner. So Base Resources reported yesterday. They have an ASX code of BSE. I've already got it in here. So currently today, so I'm recording this at about 11 a.m. Down just a little bit, but yesterday, if you look at the trade history here, yesterday they went up 14.58% based off their report they released yesterday. So why did they go up yesterday? So whenever I see an annual report or a yearly report, first thing I do is go to the financial statements, because the financial statements might be a little bit dry. Some people might go to the presentation, but the presentation's been dressed up to try to sell you their story. When you go to the financial statements, this is all about just dry as you can get. It's just numbers, and I say let the numbers do the talking. So I'd like to go straight away to the numbers, and first thing I look at is how they're doing with the sales revenue and the profit, and the EPS here. So this is the income statement here, and they've got the 2 years here. So not much growth in sales revenue. In fact, profit for operations has gone backwards a little bit, and they've got almost no change in profit or EPS. So when I looked at this initially, I wasn't too excited. No growth. So I'll go to the next line, and the next thing they look at is just the financial position, just looking at the assets. And the first thing that did grab me was the amount of cash, or the increase in cash on hand. Went from 39 million to 162 million. And the first thing I did was not get excited, but just question why we saw the cash increasing by 120 million. There's a few reasons or ways that company can do that. Increasing cash flow from the business is one, and that's the most exciting one. Maybe they did a capital raising, or maybe they borrowed some money and that's gone straight into their cash. They did actually increase the borrowing. You can just see down here in current liabilities and non-current liabilities, I spelled out very simply borrowing. So increasing borrowings, current liabilities by 25 million, and non-current borrowings have increased by 30 million. So that's only 55. So maybe, and you just also can see here, equity increased by 42. So how did they increase their cash on hand? And the cash flow statement shows the reason why. So cash flows from operating, $105 million from operating. And the cash flows from investing activities just below that, sort of like the capital expenditure. purchase of property, plant and equipment, only $33 million. So when you take into account they did borrow a little bit too, so all that together, they increased their cash by $120 million. So cash in hand, $163 million almost. That's quite exciting to me. And they didn't raise any capital. In fact, just go back up here. When you look at the equity, actually EPS here, note 6, how they calculate EPS. I'll just show you that note 6. So we go to note 6, all these notes below it are sort of explanations. And in the earnings per share, they need to specify how many shares on issue they've got. And down here, so weighted average number of shares on issue went from 1.17 billion to 1.185 billion. So no share issuing, no capital raisings during the year. So we know that the increase in cash came mostly from the operations. That's quite exciting for me. So I also then like to sometimes go into the presentation, give an explanation of the company, and you do get some good graphs and some interesting stuff in this. I got a little bit out of this page here, page 6. You can just see the profit, NPAT is net profit after tax, and that's increased from a negative in financial year 16 to $13 or $40 million. And then the graph below that's a really exciting one. They've really used the cash they've created from operations to just drive down that debt. So they've gone from a net debt of minus 151 million, so that's more debt than cash, to a positive cash balance of $88 million. And because of all that, this company is producing quite a bit of cash. They declared their maiden dividend of 3.5 cents per share, unfranked, but that's quite a fair bit based off what their share price is. So when I got home, I did a lot of calculations. You can just see here, fair bit of calculations with where they're at. So when I got home, the share price was 0.275. So all the ones in blue here are numbers I just got from the financial statements, shares on issue, and then to get the market cap, you just times these together. So the company is valued by the market at $326 million. In fact, with the share price now 2.65, you could always just update that, and it's gone down to 314 million. These other numbers, debt, cash, or get that from the financial statements. Enterprise value is just subtracting the amount of net debt from the market cap. So because they're net cash, that number should go down. So the enterprise value should be less than the market cap in this state. In this point, it's only $226 million. So it's pretty cheap when you look at some of the other things. So net equity, so 362 million. So one of the things I really like to look at is comparing the net equity to the enterprise value. And what I've got there is net equity per share is 0.306. I call that NEPS. So it's something that I'm quite keen on because, we have similar names. And the NEPS value is just dividing the share price by the net equity per share. Anything less than 1 means they're more. So essentially, if you just sold the business, this is a very raw way and very simple way of doing it. But if you just sold the business, so the net equity is just assets minus liabilities. So if you just sold all the assets and then pay off the liabilities, per share, you're going to get 0.31 cents, which is higher than the share price. So technically, if you bought the company right now for 0.265, you'll get 5 cents back with every share. So that's under 1. I think Warren Buffett believes that if the share price or the NEPS value of Berkshire Hathaway is anything less than 1.2, he will start to buy back shares in the company. So the other thing I look at is operating cash flow, and I take the capital expenditure and look at free cash flow too. And those numbers here divide the enterprise value by those two things, operating cash flow and free cash flow. Anything less than 6 there, I get quite excited because I think it's a good gauge of undervaluedness, if that is a word. So they're definitely undervalued here. And then I just looked at the dividend and dividend yield. So a 13.2% dividend yield based off the dividend. Now the question is, with this company, they do have one mine in operation at the moment. So this is this quail operation in Kenya. And you just see mine volume is starting to decrease. And you see it from this slide here, where ilmenite, rutile, and zircon production has decreased last year. They actually are forecasting this to decrease again this year. So it looks like they're not getting as much from this mine, but even though it is still free cash generating by quite a bit, it is starting to wind down a little bit. But they do have some opportunities there in Kenya they're looking at, but they also have another mine in Madagascar they are looking to get into production in the next few years. Probably the other thing you should mention is because miners are price takers, so they're reliant on the price of the metals. The price of rutile, ilmenite, and the other one, zircon, is quite important. So they do have graphs of the prices of these metals the last few years, last 5 years. You can see rutile and ilmenite have been going up over the last few years. Zircon reached a peak last year, has come back a bit. And they talk about pigment demand, which is interesting if you like to read that sort of thing. So it does look like, I mean, their earnings going forward will be highly dependent on the movement or the pricing of those metals. If it goes up substantially in the next few years, they'll become even more cash flow generative. But if it comes back a bit, less so. So highly dependent on that. I'm not sure if they talk about their other mine here, but they do have another mine they're looking at developing in Madagascar. Let's see if they do talk about that, but no, I mustn't talk about that. Yeah, there it is. So Toliara project, fairly long life, 33-year mine life. Ilmenite is the less valuable of the mineral sands. The other two ones are the more valuable, zircon and rutile. So if you do go the prices up here, you can actually see that in the prices here. So zircon is at about $1.3 thousand per ton. Same with rutile, $1.25 per ton. But ilmenite's a little bit, well, quite a bit less. It's only $200 American dollars per ton. So you probably would prefer the other two, but 33-year mine life. The other thing is then they will need a fair bit of capital needed to start this mine up. So the question is how much capital they will need, whether they go into a joint venture. The interesting thing was for me was they maiden dividend. So they do, management's maybe expecting they'll have enough for dividends and to start up the production of this mine, but they might be going to a joint venture with another mine, and they might bear a fair bit of the costs with their partner in the joint venture. So a lot of possibilities there. I'll just go to the chart. So if we go back 5 years ago, this looking at the weekly chart, so it hasn't done nothing much since 2017. It's gone almost sideways. But in the past year, with the coronavirus, it did get down to almost 12 cents, which would have been an awesome time to buy down there. And we do see the sentiment has turned around. And the news yesterday on the release of the results, it's reached a 1-year high. It's come back a little bit, is what you expect. So exciting times for this company, Base Resources, whether they can maintain that sort of dividend. And if they do, this is really cheap. If they can keep that sort of dividend going forward, maintain a good cash flow, and then actually start up this new mine in Madagascar, we are looking at a fairly cheap play here. So I'm interested in taking a bit of a position. I will hold out for a little bit and perhaps buy. So that's all for Kneppy Invest the World. I hope you enjoyed my stock of the day, Base Resources, and I'll talk to you later. And just a reminder that I'm not a financial advisor, and as such this video does not contain financial advice. So if you do need some advice, make sure you speak to a financial advisor. So I hope you are entertained by this video, or at the very least have learnt a little bit. Have a good day. Talk to you later.